Welcome everyone to this Tuesday edition of Inside India. I'm Sri Jegarajah. Let's get you across today's headlines. President Trump says the United States would help coordinate security guarantees for Ukraine after a high-stakes meeting with Vladimir Zelensky and EU leaders in Washington, D.C. India remains firmly in the Trump administration's crosshairs. White House trade advisor Peter Navarro says India's purchases of Russian oil have to stop. And India's foreign minister hosting his Chinese counterpart Wang Yi in New Delhi as the two countries look to bolster trade and bilateral ties. Right, the Asian markets are looking somewhat sluggish. There's some caution ahead of Jackson Hole and what we could or could not hear from the Fed in terms of the policy path. And then, of course, there is the prospect of a trilateral meeting that's been floated by President Trump, between President Trump, Volodymyr Zelensky and Vladimir Putin. So hopes for some diplomacy and possibly an end to the war in Ukraine, but no breakthrough at this point in time. The Indian markets join us in about 45 minutes. Here's what Gift Nifty futures are indicating for the open. We're looking at pivoting around this 25,000 mark, 24,955. So if we do get that, if that does materialise, that is upside of about 100 points. Let's give you the exchange rate while we're at it. Dollar against the Indian rupee at 87.345. We are watching developments out of Washington. President Trump is hosting Ukrainian President Vladimir Zelensky along with EU leaders just days after his meeting with Russian President Vladimir Putin in Alaska. The focus? Finding a path towards peace between Moscow and Kyiv. But major differences do remain. Russia controls about 20% of Ukraine and insists on keeping it as part of any ceasefire agreement, something Kyiv rejects. Ukraine also asking the United States for security guarantees, which will be discussed over the coming days. In a post on Truth Social after the first round of talks, President Trump said the US would help coordinate security guarantees which would be provided by European countries to Ukraine. Trump also spoke with Russian President Putin on the phone after meeting with Zelensky, urging him to meet with the Ukrainian leader and the possibility of a trilateral meeting with Zelensky, Putin and himself. Quick check on the oil markets in the wake of all this diplomatic manoeuvring centred around Ukraine. WTI at 63.11, Brent crude 66.30. White House trade advisor Peter Navarro, meanwhile, is turning up the heat on India. In an opinion piece for the Financial Times, Navarro said New Delhi's purchases of Russian crude are funding Moscow's war and must stop, warning that if India wants to be seen as a strategic partner, it needs to start acting like one. This comes as the US delegation has called off its visit to New Delhi, a sixth round of trade talks that were to be held from August the 25th to the 29th, now postponed until further notice. And new US tariffs on Indian goods, which would take the total to 50%, are due to be effective on August the 27th. In the meantime, Prime Minister Narendra Modi and Russian President Vladimir Putin spoke over the phone, where Putin briefed Modi on Friday's Alaska summit. In the meantime, Indian Foreign Minister S. Jaishankar is heading to Moscow this week and will be meeting his Russian counterpart on Thursday for a trade and economic dialogue. Ahead of the bilaterals with Russia, Jaishankar hosted his Chinese counterpart Wang Yi in New Delhi on Monday, discussing border peace, trade and bilateral ties. He said the talks were productive, while calling for a candid and constructive approach from both sides in resolving their issues.
Having seen a difficult period in our relationship, Excellency, our two nations now seek to move ahead. This requires a candid and constructive approach from both sides. In that endeavor, we must be guided by the three mutuals: mutual respect, mutual sensitivity, and mutual interest. Differences must not become disputes, nor competition conflict.
This line just in from the Indian government. India has exempted import duties on cotton between August the 19th and September the 30th, according to a government order. It's unclear at this stage whether this is perhaps a concession to the US in the face of what are now 50% tariffs that are, as we said, effective on August the 27th. So we will try and bring you more details on these lines as we get them. In the meantime, Wang Yi noted relations are returning to cooperation and urged both nations to see each other as partners, not rivals. He was also meeting Prime Minister Modi later today, and Wang Yi's visit comes ahead of Modi's trip to China for the Shanghai Cooperation Summit, his first in 7 years. Let's take a closer look at this evolving alignment and the state of diplomatic relations between India and the US and what were its strategic partners, and bring in Rachel Ziemba, founder of Ziemba Insights. Rachel, it's fascinating, isn't it? Let's start with the US and India. Trump-Modi relationship, that's gone from bear hugs to Washington labelling India as a dead economy. What's led to this sudden deterioration in US-India relations?
I think some of it is poor timing for India, unfortunately. That the trade talks went off the rails. That's true, but also that India was seen as a country that the U.S. had leverage on at the time when Trump wanted to look tough against Russia. And that moment may have passed. We'll see how these talks go. But I think there are, as you say, these challenges on the bilateral trade side, but also just this window where the U.S. didn't feel they could pressure China, who, of course, is a bigger trading partner with Russia than India is. And so it really has left India in the crosshairs. But I think it does really undermine quite an extensive period of time of U.S. administrations trying to get closer to India. And that's going to be difficult to rebuild.
Is President Trump so desperate, Rachel, for a Russia-Ukraine deal that he's willing to sacrifice the political and economic relationship with India and squeeze India with punitive tariffs?
Well, we'll see. August 27th is coming up quickly. I would note that President Trump himself and Secretary of State Rubio in the last 48 hours have made comments saying that they don't think now is the time for more sanctions or tariffs, economic pressure related to Russia. Secretary Rubio actually mentioned that he thought that if there were more sanctions, that would be a sign the U.S. had given up on peace talks, which I don't think is the case. What I'm really watching for, of course, is they've already announced these 25% tariffs on India. Would they sort of let them go ahead? My hunch is no, given if the diplomacy continues. But the fact that the U.S. and India have canceled these trade talks is not a good sign. And of course, diplomacy is moving so fast with Russia and Ukraine that we could quickly get to a point where Trump wants to make an example of an important trading partner quickly.
Indeed. And it's leading up to that, isn't it, Rachel? Peter Navarro's doubled down on the administration's position, judging from his op-ed in Monday's FT. So clearly, President Trump wants a win with the midterms approaching, and that win is a breakthrough in the Ukraine and Russia conflict. And he will continue to squeeze Putin economically. So all of this is pointing towards punitive 25% tariffs, this additional tariff, which takes it to 50, being imposed on the 27th of August, because India continues, to all intents and purposes, and we've been hearing this from New Delhi, to defy this threat of additional tariffs and buy Russian oil.
Yes, I think that's right. As always with Trump policies, and any policies, the devil is in the details. And here there are a number of exemptions that are important to watch for thinking about the impact on the global economy, on the Indian economy. Here, some very important Indian exports to the U.S. are exempt. Pharmaceuticals for now, also personal computers and electronics, so iPhones, for example. But I do think we're in a new window where the Trump administration is pushing back on two policies that were positive for maybe U.S.-India relations. One is this question of the oil price cap, which India knows the U.S. asked them to buy Russian oil and resell it for cheap. But the other one is that the U.S. is no longer as interested in India being a part of reducing value chain reliance on China. That was very much a focus in the Biden administration, maybe the first Trump administration, but now the U.S. would like that production to be at home. So I think there's still room for a deal, but the dynamics here at play and the fact in Washington, there is really a debate going on right now with a lot of people concerned that pressuring India might only increase India's outreach to China, to Russia, in ways that might be detrimental to U.S. interests.
100%, and India has been very adept at hedging its bets, even before this, with trade diversification. So that's happening now more than ever before because of deterioration and the breakdown in the US relationship. And it's doing this by aligning more closely with the BRICS and within the BRICS, and with what were strategic adversaries like China. So this is the new normal now for India, is it, Rachel?
I think this hedging is the new normal. I mean, we'll see how far it goes with China. There are agenda items where they are very much competitors, especially around manufacturing and the like. India is concerned about Chinese electric vehicles, even though they're cheap. India is also looking for technology transfer. So we'll see how far that goes. I would also say that India will also double down on relationships with the Gulf. The UAE, one of the large, trading partners and intermediaries, as well as even perhaps Saudi Arabia. India, all the evidence I see from the data suggests that the Indian government may be doubling down on the potential of importing fuel from Russia still, but on the margins, companies like Reliance, it seems, may be sourcing a little bit more crude oil also from the Gulf. So that's also something to watch.
Yeah, that is interesting. And it doesn't appear that India is yielding to the threat of punitive tariffs. And we are getting some mixed signals from the Indian refiners as to whether they are complying. And this raises a question, doesn't it, Rachel? Even if the tariffs are imposed, and it seems to be moving on that direction, we'll be the wiser on August the 27th. How is all of this going to be enforced? And like with the Iranian sanctions, and there is Russia's shadow fleet, remember, which is still active, there is always a back door.
There is a backdoor, and I think that illicit financial and shipping network that already characterizes this trade is likely to become more active in the scenario where the tariffs go into effect. India has struggled at times to pay for the oil, more so than China. India, of course, also struggles to find as many goods to sell to Russia. So the barter trade's a little more complicated. But overall, if the Trump administration goes for these tariffs and continues to not impose financial penalties at the same time, cracking down on the shadow fleet, then I think we could just see more oil getting disguised. And you raise a really important point, Sri, about enforcement. There's another important policy lurking in the, lurking ahead, which is the European Union's decision to stop buying refined fuel, so diesel, from countries that use Russian crude oil as a source product. That's scheduled to come in the fall, and would mean less imports of Indian refined products if things don't change. That's likely to be even harder to enforce. So I do think all of this pressure and this uncertainty, as well as the fact that some OPEC plus countries outside of Russia are likely to increase supply a bit more, might mean on the margins that India starts to move away from that sort of peak import of Russian oil. But
Yes.
ultimately, I think politically, the rhetoric from the Indian government is likely to remain strong.
How challenging is it going to be for a company or a conglomerate, rather, like Reliance to move away or to cut its Russian oil purchases, because it has long-term contracts with Rosneft, from what I understand? And is there any substance to the accusations from the administration in Washington that the Ambanis and Reliance have effectively been profiting from buying discounted Russian crude and selling it at a higher markup in the Indian market?
Yeah, I can't speak to the latter, but I will say, whether it's the Indian market or more broadly, the whole idea of the oil price cap was that India and others would buy Russian oil cheap and pass it on, refine it and pass it on, whether it was domestically or internationally, at a relatively cheaper price. And that second piece has not happened to the same extent. It definitely, when you look at the data, it really is Reliance and the Jamnagar refinery that is buying most of the Russian crude oil, and the Russian discounted crude has been part and parcel of the increase in throughput, and particularly exports that Reliance has engaged in. So that is sort of a risk going forward. Big question here, it comes back to OPEC Plus and other suppliers. Until 2022, India barely bought any Russian crude oil. They mostly sourced their oil from Iraq, from the Gulf countries. And so in theory, they could return. The problem is that even though OPEC Plus has hiked up their maximum capacity, the actual volumes haven't really hit the market yet. That may have to do with air-conditioned season and demand. It may have to do with price, but the challenge for Reliance and for India more generally is that replacing Russian crude will likely mean a higher price for those imports, and narrower margins, and probably some more pressure on the current account.
There's a quid pro quo here as well. That's also a way out for New Delhi, isn't it, Rachel? As part of a broader US-India trade deal, will Washington back off from punitive 25% tariffs on India if India commits to buying more US energy? Is that ultimately what it comes down to?
It might. And I think that could be something the U.S. has in mind with where LNG is concerned. Though, of course, LNG has been quite expensive in the global markets. And for India, there's been more preference to use domestic coal and other sources. Where oil is concerned, the U.S. does have some production, but it's not best aligned with what the Indian refineries process. The U.S. produces a lot of light sweet crude. What Indian refineries are prepared for are somewhat heavier sour crudes, actually a little bit more similar to what we have in some other parts of the Americas, as well as Russia and the Gulf. So I think indirectly, you could see pledges, of course. These are negotiations. And as I know you and your colleagues have covered well, a lot of countries have have promised some pretty unrealistic stretches about how much energy and other products they're going to buy. It's possible India could do the same. But I imagine the U.S. is also really going to be looking for some concessions on the agricultural side. And as you know,
Yes.
even better than I, that's very sensitive for India.
That being said, we just got a line from the government, actually, Rachel. You may have seen this as well. India exempts import duties on cotton between August the 19th and September the 30th, according to a government order. This looks like it's a concession, but a relatively marginal concession from a market access point of view, yes?
I think that's right. Now, of course, this is a global story, and for India, any concessions they make to the U.S., there might be pressure from other countries. We know it's not so long ago that the India has been signing agreements with others. Indian cotton, definitely a very protected sector, is relatively expensive, and that, of course, can add to sort of price pressures and cost pressures for textile manufacturers. So I could see there might be some arguments for India's own self-interest to make those measures. But you're right, we should watch for other such announcements, and also how that might tie into these ongoing conversations that you mentioned at the start of the program with China, with some of the other trading partners.
Some major event risk in the next 2 weeks, of course, and it could be make or break for the US-India relationship. All eyes on August the 27th. Rachel, it's always a pleasure speaking to you. Thank you very much indeed for your analysis. Thank you. Rachel Ziemba there from Ziemba Insights. We're back in 2 minutes. Welcome back. Over in Japan, the African Development Forum is set to kick off in Yokohama tomorrow. Lin joins us with more. And Lin, the government is pushing for more private enterprises to invest in Africa, and that hasn't really materialised quite yet.
Indeed. So the focus for this year, TCAD 9, is really on these longer-term partnerships via investments. But you are quite right, even though there's been a number of pushes in the past, including in the early 2010s, we have only seen a bit of a trickle when it comes to Japanese funds, Japanese investment in Africa. If you look at the latest outward FDI numbers as of 2024, it shows that Japanese investment in the African continent since at around $0.55 and that is despite the fact that there's been huge appetite for foreign investment for Japanese companies, and also the country is at a record when you look at its net external assets as well. However, in terms of the summit that will take place this week, there is expectations around some major announcements, including reports here that the Japanese government will announce a logistics network that connects Africa via the Indian Ocean. And I spoke with a stakeholder here, a management consultant that helps Japanese firms interested in Africa, and he says that this makes a lot of sense. So let's take a watch.
Look at it from a Japanese standpoint, right? You're an island, or actually multiple islands, and you're pretty far from the continent called Africa. India is actually very well placed, and let me actually run things from there, right? And so the Japanese corporations have already been really well established in a number of cities in India in terms of logistics. When you look at, again, just even the country of Ethiopia, you have, I believe, at least between 2 and 4 direct flights out of different Indian cities into Ethiopia. That's just Ethiopia, right? So using India as a platform, right, as a springboard to go into Africa, I think is a smart one. The only risk is that in terms of the know-how, now you're using Indian executives, Indian expats to really drive your presence into Africa. And I don't know if I could argue that, again, an Indian executive would know super well the African environment in different African countries.
And certainly this is one of the concerns around why there hasn't been more investment by Japanese firms into the continent, the concerns around a lack of infrastructure in terms of the supply chains, but also there's concerns around the legal frameworks that exist as well. And also, the fact that, we take the example of a trading house, many of them have these interests in terms of commodities and in terms of, potentially African countries, but there are concerns around the fact that there's a bit of a cultural divide, that it takes often rounds and rounds and rounds of talks, and often, the African counterparts can lose that patience as well. So these are some of the aspects that we will look to as well, given as well that we are talking about a time when the global trade dynamics are shifting rapidly as well.
And of course, China overshadows to a large degree developmental infrastructure investment in Africa, so they're working under their shadow. Thank you very much indeed for that, Lynn. Coming up on the programme, news of consumption tax overhaul gave a new leg to the markets on Monday. Is this momentum going to continue? We'll do a deep dive into the Indian markets with Saurabh Mukherjee coming up next. Welcome back to Inside India. Let me just update you with some breaking lines that we are getting from S&P over the fiscal outlook, fiscal position for the US sovereign and the economic outlook. And S&P says this: US AA plus, A-1 plus sovereign ratings affirmed. The outlook remains stable on steady, albeit high, deficits. S&P expects US net general government debt to approach 100% of GDP, given structurally rising non-discretionary interest and aging-related expenditure. As far as the economic outlook is concerned, S&P expects the economy to grow around 2% following a slowdown in 2025 and 26. US average annual real GDP growth will decelerate during 25 and 26 to 1.7% and 1.6% respectively. The US outlook indicates fiscal deficit outcomes won't meaningfully improve, but S&P says it doesn't project persistent deterioration over the next several years. With that, US dollar index is trading at around 98.17. Let's take a look at US Treasuries in reaction to these lines from S&P. In the benchmark 10-year bond yielding 4.3394, the rate sensitive 2-year bond 3.7734. Event risk, big event risk this week, given the Jackson Hole Central Bankers Symposium later on this week on the 21st to the 23rd of August. Now, we are counting down to the market open in India. This is how we are shaping up. Let's give you a glimpse of futures 15 minutes away from the official market open. We are looking at 24,953, so that would represent a lift to benchmark equities if the number does materialise on that level. Dollar-rupee exchange rate at 87.2313. Now, India's jobless rate easing to 5.2% in July from 5.6%. Rural hiring picking up ahead of the festival season. Urban unemployment, however, rising slightly to 7.2%, with youth joblessness still high. Markets hope the GST cut expected to come in by October will support jobs and manufacturing among India's urban youth aged between 15 to 29 years. Unemployment increased to 19% in July from 18.8%. Now, India's market regulator SEBI is proposing to ease IPO rules for large companies. SEBI says firms with a post-listing value of above 5 trillion rupees could be allowed to sell just 2.5% of their equity. That's half the current requirement. The move aims to encourage big companies that might be facing trouble in diluting equity while also giving them more time to meet public float norms. SEBI has invited comments until September the 8th. Speaking of IPOs, we have a shiny new entrant to the markets today. Jewellery retailer Bluestone debuts in less than an hour's time. Its IPO saw tepid demand, subscribed 2.7 times overall, with retail investors taking up only 1.35 times their quota. Non-institutional buyers too shying from bidding, booking just 55% of the shares reserved for them. Issue price for Bluestone's shares is set at 517 rupees. And Kotak International, the global arm of India's private lender Kotak Mahindra, has been granted a licence by the UAE to sell investment funds and provide portfolio management services. It is the first Indian firm to receive approval from the UAE Securities and Commodities Authority amid growing interest in Indian markets. Indian nationals make up the largest proportion of expats in the Emirates, accounting for about a third of the population. Kotak plans to launch its first India-focused retail funds in the Gulf by the final quarter of 2025. UAE does not tax capital gains or income, making it attractive for global investors. Let's get a sense of how to navigate the Indian markets, given the balance of risks, both emerging externally and domestically. Saurabh Mukherjee joins us now, the founder and CIO of Marcellus Investment Managers. Saurabh, great to have you on the programme. Let's start with the consumption story. And how much momentum do you think there is, given these sizable changes to the GST regime?
I think this was much needed. This was much needed. You flashed up quite appropriately the urban joblessness numbers. The IT companies are cutting people. The banks are reducing headcount. The media companies are increasingly turning to automation and AI and reducing headcount. So we needed a boost. I think this will, to some extent, neutralize the damage done by the US president's tariffs, but I'm not so sure this will entirely neutralize the damage. So the ideal situation for India will be if by October, November, America brings down that brutal 50% tariff to somewhere around 20%, and the GST cuts go through, because the joblessness numbers that you're showing are pretty serious. The urban youth numbers are punchy. My situation is even in the sort of job I do, white collar, affluent urban jobs. I think there's been very little job creation there in the last 3 years, and that's dragging down consumption. Net, I think it's a $10 billion boost to consumption, the GST cuts, the indirect tax cuts that the government is expediting. But unfortunately, Donald Trump's tariffs do twice as much damage to India. Yeah. So a sweet spot for India will be Mr. Trump reducing the tariffs and the GST cuts that the government is promising coming through by October, November.
Saurabh, so on balance, when you look at the macro and the market softness, is this an air pocket? Is this a speed bump? Is this a relatively minor interruption that we can get through, or is it portending a deeper correction in these markets?
I think India does have a sort of twin challenge, really. Valuations are punchy, especially small and mid-cap valuations. They're at the highest they've been for 25, 30 years, small and mid-cap valuations. Earnings growth is crawling at 5-6%, and small and mid caps are trading at 30, 40, 50 times. We'll need one of the two to change. Either valuations pull back or earnings growth goes towards 15-20%. It's hard to see how earnings growth will suddenly jump from 5-6% to 15-20%. There is a recovery that will happen over the next couple of years, but I'm expecting a slow recovery in the economy. And therefore, I think it's more likely than not that valuations are the piece that will correct at some stage over the next couple of years to give investors like me a better entry point, right? And in our small and mid caps portfolio, we're sitting on lots of cash. And I think investors across the world are doing the same. We've seen pretty savage selling in Indian equities by foreign investors. So either earnings growth jumps from 5 to 15% in the next 12 months. I think that's unlikely. Or valuations correct from 30, 40 times in mid caps to somewhere around the 20 mark. I think that's a more likely outcome.
What was it about earnings season that disappointed Dalal Street specifically, Saurabh? And how does it change the narrative as to portfolio allocation?
Sure. I think it's been happening for the last 4 or 5 quarters. Consumption is 60% of India's economy. And as we are discussing, right, and given the lack of jobs, given that household savings, the RBI is saying that household net financial savings, net as in savings less borrowings, household net financial savings are at 50-year lows. So households don't have a lot of money. Jobs are few and far between. As a result, consumption has been subdued. And that being 60% of the economy, that drags down earnings growth to 4, 5, 6%. And this has been happening for the last 4 or 5 quarters. Valuations have been elevated. My reading is over the last 3-4 months, the foreign investors are throwing in the towel. India's been the worst performing emerging market this year. In fact, it's been the worst performing large market this year as foreign investors throw in the towel on that. And I think it's not in that context, the RBI's rate cuts, which have come through, the government's tax cuts, which are coming through, these are very, very important, right? I think the government is doing everything possible to revive the economy. Just that it's going to be a long slog. I think we're looking at 4 or 5 quarters of a gradual earnings revival. And in that interim period, Dalal Street is having to contend with eye-watering valuations. You just mentioned the IPO today and the lack of appetite for that. I think that's becoming a big issue in our country. Yes. Valuations are punchy in the context of weak earnings growth.
What about the external risks, Saurabh? It doesn't look as if the US negotiators are going to be in India for the 6th round of talks. And then, of course, this deadline is looming on August the 27th, and we could very well see the tariff rate being taken up to 50% if that additional 25% punitive tariff on India for importing Russian oil goes through and is effective. What happens to the markets and macro then under that scenario?
So I think there was a savage piece in the Financial Times yesterday by one of Donald Trump's top advisors. I haven't read anything as
that's
savage.
right.
That's right. So I haven't read something as brutal on India to that effect for the last 20, 30 years. So it clearly seems somewhere in Washington, D.C., the point of view is that India has to be prevented from buying oil from Russia. That's the only way Putin will be brought to the table for a deal on Ukraine, and therefore let's turn the screws on India until Vladimir Putin signs a peace deal on Ukraine. If that's the point of view, then really the keys to the kingdom, the keys to India's external situation lies in Moscow, and we'll have to wait and watch over the next 2 weeks how that plays out. In that context, I think it's very important to note the Indian Prime Minister's visit to China at the end of the month, right? I think there will be some sort of India-China deal, probably around rare earths. India will want China to start sending rare earths to India again. What will India concede in return? I don't know, but I suspect there'll have to be some deal around EVs, electronics, and so on. So it's a complex mixture. Russia and America dueling with each other, India and China joining hands to counter American pressure. I'm not a geopolitical expert, and this is a little above my pay grade, but I'm optimistic. That this
You and me both, Saurabh. We all have to be armchair political analysts in this environment. It looks like we are seeing ultimately closer alignment within the BRICS. But let's bring it back to the markets. How should we approach the listed Indian oil refiners in this environment?
Yeah. So I think that's one category of investment where I think investors like us don't get paid for taking on the same geopolitical risk that we were discussing, right? They are subject to political constraints in the Indian context. Yes. Oil obviously is a big election issue. They're subject to geopolitical plays as discussed in that FT op-ed piece that Peter Navarro wrote. And I'm not so sure the share prices there give us enough upside on the magnitude of the political risks involved. I would far rather focus on the quality large caps in India. They've been sensibly valued now for the last 2 to 3 years. As the economy slows down, we are seeing quality large caps, e.g. HDFC Bank, stage a smart comeback. And I think that's the one place in the Indian market, high quality large caps. That's the one place in the Indian market I'm seeing value, and that's where the bulk of our resources in India are deployed.
So let's talk about that specifically, Saurabh. And when we talk about large caps, we talk about banks and financials. In this environment, is that where you want to be at a sector level, given where valuations are and given their performance in the earnings season? Or are there even risks there when you look at unsecured credit and rising bad loans?
Sure. So I think what we have to sort of counterbalance is two things. Corporate India, for the first time in its history, corporate India has net cash, right? And if there is going to be an economic recovery over the next 2 to 3 years, some of that net cash will be deployed. Companies will borrow money for capex. I think the beginnings of that seem to be emerging, right? This might be famous last words, but I think beginnings of a corporate capex recovery are on the cards, and banks should benefit from that to some extent. You're absolutely right. We have to counterbalance that with asset quality. And I think that's where HDFC Bank and ICICI Bank are doing a good job. They've got strong liability franchises, low-cost funds. Their asset quality has been impeccable at a time when broader asset quality has deteriorated in India. These two banks plus State Bank of India seem to be pulling away from the entire banking industry. And I think that's where we are getting very interested in perhaps allocating a little bit more to the high-quality banking franchises in the country as a potential play on an economic recovery.
Let's bring in the tariff uncertainty and associated growth concerns, which have been impacting IT services, pharma, automakers, and textiles. Have we seen the worst of it, Saurabh? And how cautious do we have to be when we allocate towards these sectors?
So far, America has left IT services and pharma alone. So far, America has left IT and pharma alone. There's some presidential order which gives them exemption from these 50% tariffs. Let's hope that that continues, because if America loads those up with 50% tariffs, then the macro challenge for India becomes even more serious. Thankfully, IT and pharma are India's biggest exports. So our biggest exports are still exempt from those 50% tariffs. Amongst the IT names, we've been large holders of HCL Tech for a couple of years. We remain optimistic that the strength of the American recovery will allow HCL Tech to monetize its strength in infrastructure management, in cloud, in digital rollouts for the Fortune 500 companies. Beyond that, auto and textiles, I think, is a tougher situation. Even with 25% tariffs, Indian auto ancillary exporters, the textile companies will face an uphill task with 25% tariffs. At least the auto guys have domestic relief because of the indirect tax cuts announced, flagged by the PM 48 hours ago. The textile guys, I think, are on a really tough wicket here. Export challenges and no potential domestic relief that I can see for the textile companies.
Saurabh, just getting back to GST, this is effectively, these sweeping changes to the GST regime are effectively a form of consumer-focused stimulus, yes? And do you think then that more is coming? And does the RBI have to do more and support this on the monetary policy front?
So I've been saying for several months now that I think the RBI will have to cut several times. Household debt is amongst the highest. Household debt in India today as a percentage of GDP is at an all-time high. And if you take out mortgages, right, if you remove home loans, household debt ex mortgages as a percentage of GDP is amongst the highest in the world. So I think the RBI will have to cut time and time again. I think it has the room to do that. Inflation is subdued in India. Wholesale prices, in fact, are declining over the last couple of months. CPI inflation is 1.5%. The RBI has room to cut. I think it should cut over the next 6 months. And hopefully the government will, once the government sees proof that this GST cut, the indirect tax stimulus, is working, there'll hopefully be more there. India desperately needs a consumption revival, a jobs revival, and the two are linked. Consumption revival will only happen when jobs are created, and the central bank and the government of India, I think, will have to work in tandem for that.
Saurabh, after a slow start, what do you make of the momentum that we are now seeing in the IPO filings and the deal flow?
So I think the IPO market always worries me, because this is where the canary in the coal mine often is. If you see a very excited IPO market and heavy oversubscriptions for new IPOs, that tends to suggest the top of the market. In that regard, actually, I feel far more confident that the IPO market is a little subdued, as it has been until recently. I would say there's another 100, 150 IPOs, usually by and large private equity exits in the pipeline. It's a good thing that they're coming, and the only thing I hope is there'll be realistic expectations of these IPOs, rather than what we were seeing a year ago, 30, 40 times oversubscription, and then retail investors being disappointed thereafter.
And Saurabh, what do you make of the reform efforts from SEBI to ensure a smoother functioning of the market, putting the guardrails in, and after that shakeout that we saw with Jane Street and what happened in the derivatives end of the market?
I think to give the regulator credit here, for the last 2 years, they've been saying repeatedly that the F&O market is overheated. It's retail investors are losing money by the handover phase. I think SEBI's repeatedly published stats showing that 90% of F&O investors lose money. What the Jane Street issue has highlighted is those annual losses for retail investors run into multiples of billions of dollars, right? I think I read a Reuters piece 3 or 4 days ago suggesting that something like $6-7 billion a year are being lost by retail investors. At a time when we are discussing weak consumption, weak jobs, high household debt, right? $8 billion per year is a lot of money. That's actually equivalent to the indirect tax cut the government is expediting. So the more the regulator does in this area to tighten up F&O trading, because I don't see any tangible economic benefit to India for running a casino like this, where money is being transferred out of retail investors' pockets in India. $8 billion are being sent to smart global traders who are using powerful algos to game game the retail investor in India. So all power to SEBI in this regard. I hope they squeeze the F&O market further and reduce volumes further.
Thank you for that, Saurabh. And just finally, if we can turn to the automakers, and June, it was rough, wasn't it? We saw sales slump for the top automakers, but now that we have this GST overhaul, do you see that as a sector that is going to shine and come back?
I think that's the view that the Indian market has taken, right? The rally yesterday in the car manufacturers suggested that there will be benefits to especially the smaller car manufacturers such as Hyundai, such as Maruti. Where I'd be a little careful is, my reading is the Prime Minister's trip to China might presage, the Indian Prime Minister's trip to China might presage a larger play by BYD in India. And if that's the case, if BYD is coming to India, but potentially in a JV with a powerful Indian firm, if BYD is coming to India, then I think the Indian automakers will have a far greater competitive challenge than they have probably encountered ever in their lives.
That is going to be a major event if that does transpire, Saurabh, but it have implications, of course, for Tesla, which has just recently planted the flag in India. So that could be a fascinating space to watch, the EV market. Saurabh, I'm going to leave it there, sir. Always great catching up with you. Thank you very much for your insights. Saurabh Mukherjee there from Marcellus Investment Managers. Now, Indian markets have joined the trading day. We'll take a look at some movers in Mumbai after a short break. The market there, the benchmark up by just 0.2%, nearing 25k. We're back in 2. Welcome back. We are just under 10 minutes into the trading day in India, and the benchmark is trying to make a run on 25,000. That's the next big target. Not quite getting there, but up by 0.2%. Let's give you the exchange rate while we're at it. Dollar rupee at 87.2263. Quick check on the automakers listed in Mumbai. We were just talking about this sector with Saurabh. Pairing some gains after yesterday's massive surge. Markets found optimism from the proposed GST overhaul. Reports say after the restructuring tax on smaller cars could fall under the 18% bracket from the current level of 28%. Luxury and sports cars could also see some relief. However, they would be placed under a special category, attracting a tax rate of around 40%. That's still lower than the current levy, which includes a special cess tax ranging from 17 to 22% on top of the 28% tax. Let's take a look at Hindustan Zinc, which announced that it will be investing more than $437 million to build new metals reprocessing plant. The facility, with a capacity of 10 million tonnes a year, will recover metals accumulated from tailing dumps. The miner says the plant will improve overall recovery and support its goal of doubling annual capacity to 2 million tonnes. This latest project follows Hindustan Zinc's plan to build a new metals complex in Rajasthan. And Reliance's Jio has indirectly raised tariffs by 20% with entry-level telecom plan withdrawal. Shares surging today, up by almost 2% for Reliance. One final check on the Asian markets. Last time I checked, they were on the defensive, with a few exceptions. Shanghai Composite, Malaysia's benchmark, the Straits Times here in Singapore, and the Hang Seng and the Nifty 50, of course, which we just checked for you, are putting on some marginal gains. That's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East. Have a good day.